How I approach risk. Losing well. So if we know that losses are coming no matter what, then it makes sense to start there. And if we manage our losses well, then we can focus on maximizing profit without having to worry too much about sinking our account, which is one of our primary goals. You can't make money without having funds to trade. So I want you to get used to the idea of taking losses regularly and becoming comfortable with it. I know this is very counterintuitive for some, but we have discussed what the fear of loss can do. This is part of the reason we should be trading small relative to our account size. One loss should have no meaningful negative impact to our account and also to our psyche, right? Everyone's risk tolerances are different, and maybe at this point you've experienced a loss or two that creates that knot in the center of your stomach or causes you to scream at your computer. And it's okay, and it's part of the learning process, but there is a better way. The trading small reduces the impact of the emotional, which impacts the psychological over time. From now on, I want you to think of losses in terms of account percentage, if not doing so already, instead of pure monetary terms. Preservation of capital. Thinking in terms of overall percentage helps take the focus off the dollar amount, off of the equation, which is where most of the emotion comes from. So if I'm risking 1% on every trade, and I know through testing that a series of 8 losses in a row is possible, then I can mentally deal with that much better than, wow, there goes $100, and another 100, and another 100, or 1,000, or whatever, right? Depending on your account size, those numbers change. But what hurts worse is I lost 5% of my account, or what hurts worse? I lost 5% of my account or $500. Both happened, but if we focus on our losses in a meaningful way and look forward to learning from them, then they actually become an asset, even though initially they are a liability on our balance sheet. If it sounds a little like mind manipulation, it is. You cannot be consistent if you are worrying about the next loss, and that's just the way it is. Therefore, we must change our minds about what it means to take a loss on a trade. And it's kind of like the idea of being like in a flow state, right? If you're worrying or you're thinking about the past or the future or the last thing that happened or whatever, it's impossible to get into a state of flow, which is essentially just like a hyper focus on the right now, where you're just taking in information as it's coming in and you're processing it purely, right? So I like to put this in, like, an example would be like, for me, I'm a surfer and a snowboarder, and particularly whenever I'm snowboarding, right? Whenever I'm going down a hill, especially, let's say I'm doing a black run or something very kind of technical, right? Oftentimes I'll put in my music and I'll be jamming out to it, but as soon as I go down and I'm in the moment and I'm paying attention, and every single move, everything is a reaction to what's happening in the moment. At that point, I'm in a state of flow. Whether I'm going through trees or I'm maneuvering around, extremely steep parts of the terrain or moguls or whatever, I'm 100% focused on exactly what's happening in the moment. And so what ends up happening is by the time I get to it's like almost like, even though I turn on the music, I don't even hear the music until I get to the bottom. Once it's over, it's almost like, boom, the music pops into my head, because I'm so focused on what I'm doing, I couldn't even hear the music that was happening in my own ears. It was driving in straight into my brain, which is pretty crazy, but I was so focused on the moment. And that's kind of like how our trade should be. Depending on what you do, that's probably more so with a day trade, but a swing trade is obviously going to be different. But anyways, the point is that we're not thinking about the past, or we're not worried about the past. We're not worried about the fact that we just had, a loss on our last trade, and now, what that means for the current one. What happened in the last trade has absolutely nothing to do with what's going to happen on the next trade. And it's also no different than, a professional sport, like let's say, like golf, for instance, right? Professional golfer gets up there, gets on the tee box, and he has a bad shot, right? Let's say the course goes to the right, he hits the shot, ends up cutting to the left a little bit, and puts him in the woods. Those guys are so good, they have to and my buddy Dan, he says it like I think like a goldfish, right? Whenever we're teaching our kids to play baseball, right? We're coaching. He's like, think of it like a goldfish, right? Goldfish just doesn't remember anything, so you just forget about it and you move on, But the idea is that, especially for a high performance process like this, like the professional golfer, you take that shot, and even if that one is awful, you have to completely put it in the back of your mind and understand it has nothing to do with what's about to happen, and so you're moving forward completely fresh, right? That you're not thinking about or worried about what happened in the past, worried about. And when we don't follow this process of trading small, right? Talk about, just mentioning losing 5%, right? Which can hurt, right? When you think about that going into the next trade, it becomes it's a liability, right? It becomes a liability to what's going to happen, to what you're doing in the future. And if you let that creep in, and then those larger amounts are exaggerated. So when it's a smaller amount, it's much, much easier to just brush off and move on, right? So that's what we're after. I also like to have a loss limit on the day, so that on any one day I do not do irreparable damage to my account, kind of like 3 strikes and you're out. Obviously, I'm not reading things clearly at that point, and though I may observe the rest of the day, I'm not allowed to take a trade. And this is more for day trading, but you get the idea. And the idea is just so that you don't go on what's called tilt, and you sink your account, or again, do major damage in one day. And I kind of want to go back to the title of this was How I Approach Risk. The idea behind this was that this is how I approach risk. This is the way that I see that professionals approach risk. And so this is how I'm just presenting it this way for you to be able to take away bits and pieces of it, or even all of it if you're not familiar with it or are not experienced in this kind of thinking. And so that you can kind of take bits and pieces depending on where you are in your journey. And so it's how I approach risk, but it's, in my opinion, how the professionals do it, and how you should think about it and look at it as well. All right, the law of probabilities. So a coin flip has an even distribution of 50%, but over a large sample size. So grab a coin and start flipping. See how many times it will land on heads or tails in a row. This changes how we must view and approach our odds. Over a small sample size, or for example, each individual trade, things can fall outside of the norms that happen over many trades, right? This is important to realize, that even though you determine through testing that 7 losses in a row is normal, it can go beyond that without anything being wrong, right? And these are kind of like the higher standard deviations of things, where it's like the likelihood of it happening is much, much less, but it's still a possibility, right? And so we have to keep that in the back of our mind, that like I say, so before you trash your system because of an anomaly, we're going to look at the chart below. But that's the idea, is that crazy things can happen, right? So as much as you'd like for it be normal for your trading system to make 10 wins in a row, let's say I would say that's kind of on the high side, but let's say it's normal that you see 10 wins in a row. You could see 15 or 20, right? That's not out of the realm of happening, because anomalies do happen. It may never ever happen again. It may only happen once, but it's possible. And the same thing can happen with your losses. Just out of sheer luck and the way that things work, those anomalies have caps, right? They only go so far, but again, they do happen. So it's just something to be aware of, right? So you don't want to, once we really dive in and we start testing our system, you have to be aware of the fact that this happens, because so many times, in the past, when I think back to whenever I first started and when I was going through and I was struggling, I would come up with an idea, and I would, well, that lost 7 times in a row. And that's before I was even tracking the data, but it seemed like it was too many times in a row, so therefore it must be bad. And that's not necessarily the case. You may have it to where you have that bad run early on when you first start trading that system, and you may never have it again, or you may not see it again for 1 or 2 years. But if you take that as significant in the beginning and you throw it out, then you could potentially be throwing out a profitably good system just because you didn't understand that. So let's go dive deeper into that a little bit. So when your odds seem to be 50% based on, so this is a coin toss, right? So coin toss, heads, tails, you should have a 50% chance of landing on heads or tails, right? But what we know from taking statistics is that this is not the case, right? So when your odds seem to be 50% or 8 out of 16, this is 16 coin tosses, there will be times when a string of losses or wins can last well beyond that. And it doesn't happen often, but it is normal and you should expect it at some point, right? So we talked about that. So just like, let's say, probability of heads, right? So this is a person that's choosing heads. So you see the normal curve distribution is going to happen around the central part of that, right? So 50% would tell you, having something 50% odds should tell you that you do it 16 times, and that 8, it should land on heads 8 times, and it should land on tails 8 times. And so what we see is, for the most part, that is correct, right? So that's what happens the highest amount of times. But what we also see is that it's often that, or it's not out of the realm of possibilities, or even you should almost expect that's going to deviate from that central number, right? So even something that seems to be a 50%, 50-50 is not as it seems on the surface, right? So it would say not even that uncommon to get 12 out of 16 times that you'd land on heads, right? But also just about the same, you're going to get, it's going to land 4 times. So you're going to lose much more often than 50%. And then also the fact that you could get out to where you could actually, if you do it enough times, you could actually see where you only land on it twice, or just 1 time, or maybe even 0. And you can actually flip tails 16 times in a row, right? Now, it doesn't mean that the odds have changed, right? Your odds are still 50%, but the anomaly of that specific run was much, much different. And outside of that, it just doesn't happen that often. All right, risk only what you can afford to lose. And this is very important. So we want to rush our way to success often, and it causes us to make poor decisions when we otherwise wouldn't. It can be easy to fall into a gambling mindset at times, especially when you believe the odds are in your favor, right? It makes you want to push things. The markets are not going anywhere. So financial markets are the playground for the rich, so there's no need to rush into risking large sums of money in the beginning. Saving up for your trading stake will also help cement the fact that it is hard-earned money and that you will work just as hard not to squander it. So no rent money, no emergency savings that wasn't allocated to trading. Nothing that will force outside pressure on you to succeed or you lose something important. Trading is hard enough without any of that. So markets like Forex can allow you to tailor risk to quite small account sizes, since you can reduce leverage by trading in smaller increments. I began trading Forex with a $50 account, trading in 10-cent increments. So no sweat if you need time to build up equity. There are options available in the meantime that will allow you to continue trading and learning. So, and I'll just mention this again too. I don't remember if I've gone over this in the past, but like I said, I literally started trading Forex with $50. And so depending on how you set up how you're going to trade, like 10-cent increments was the lowest amount. So like $50 was the margin, right? So I didn't need to trade all $50, but that was how much I needed to open the account. So that's doable for anybody, right? And the deal is, and the way that I look at it is that if you cannot be profitable trading in 10-cent increments, now it has to be enough money to capture your attention, right? 10 cents is too small and you can care less about it, and so you trade it and you're like, it's beans. Get it up to the point where you feel it a little bit, right? It's where you feel the pain, right? It's like that may be $1 for you. Again, $1 risk is doable for most all of us, right? But if the dollar is what means something significant, or not significant, but where you feel that edge where you're like, okay, I need to pay attention to this, so I need to watch this. That's kind of the idea, is that you're like, I don't want to just be like, it was just 10 cents, I don't care. It was just 10 cents, I don't care. Well, you start doing that with dollars, it adds up quickly, and then eventually you will care, right? So, a dollar here and a dollar there is maybe the important number for you, or maybe it's $5, right? So, but either way, as you're implementing your strategy, implement it small, right? Prove it over, over the course of a month or two, where you're trading in these smaller amounts. If you're not profitable with small amounts of money, you cannot be profitable with bigger amounts of money, because the emotional gearing and the intensity is ramped up by that dollar amount, and you become accustomed to trading larger and larger amounts over time, and that's fine as long as you're doing that correctly and you're not just throwing money away, But and this is somebody, this applies to somebody who with $1 million in their retirement, and like, hey, I'm just here to just play around, versus the the 25-year-old that's saved up $1,000 and is trying to learn how to trade, right? So that's a big gap in there. So those monetary amounts are going to be much different depending on who you are. But like I said, that to be said, is that you start out trading small. You have your trading system. You trade a small amount, a small meaningful amount, and if you can't be profitable with that, then there's no sense in jacking up that amount. So instead of starting big, just do the opposite. Start small and work your way up. So you become profitable at risking $1. Cool. Bump that up to $2. Bump it up to $5, right? Once you're profitable at $5, bump that up to $10, right? Now, if you're swing trading, I don't necessarily recommend that, because it's going to be much harder for you to develop results over time trading much smaller amounts. And you don't have the kind of, again, the emotional and the intensity that happens in like a day trading setting, because you're not generally staring at the charts. You're checking charts, maybe like once or twice a day, and making decisions over time. So there's not that same kind of pressure, should I say.